Hi friends, welcome to Sure Success Home Tuitions. In this video, I will be covering all the class 12 syllabus of accountancy from volume 1 to volume 3 about the important formulas and formats. So first, I'll be teaching the format of profit and loss appropriation account. So the format of profit and loss appropriation account is particulars, rupees, particulars, rupees. So see, there are recommended steps for each and every format. If we are following that recommended step, we will never be missing or we will never be making any mistakes. So the first recommended step to follow in this profit and loss appropriation account is to write this net profit. If it will be given in the question, if it is a net loss, you have to write it this side. I have written here like by net profit brought down. If it is a net loss, you have to write it in the debit side to net loss. So here the important concept is that when there is a net loss, to net loss, if you are writing, then you cannot provide interest on capital, you cannot provide the partner's salary, you cannot provide the transfer to reserve. Okay, so you can only provide this interest on drawings only. Okay, so this interest on drawings also should be provided for the half of the percentage only. Otherwise you can calculate as for interest on drawings only for 6 months. Interest on drawings only to be calculated for 6 months only. Since the period for the interest on drawings is not mentioned in the question, you have to calculate the interest on drawings only for 6 months only. Okay, so if there is a net profit brought down, you can show the interest on capital. Suppose, for example, if the rate of interest on capital is not given in the question, then you need not calculate interest on capital. If the rate of interest on capital is given in the question, you have to calculate. Then partner's salary, same way. Partner's commission, this is partner's salary per annum. If they have given in month, you have to calculate it into per annum. Then partner's commission, the same way. Before commission or after commission, there is a formula, you can apply it. So then transfer to reserves. They will say this much percent of the profit has been transferred to reserve. So this transfer to reserve also, only if there is a profit, you can transfer it. Otherwise, if it is a loss, you cannot transfer this reserve. So the result will be either profit or loss. The result of the profit and loss appropriation account will be either profit or loss. So the profit will be shown in the debit side of the P&L appropriation account. The loss will be shown in the credit side of the P&L appropriation account. The next topic which I will be covering is that partner's capital account. So here they are showing two different methods, which is called fixed capital method and fluctuating capital method. Now I am showing you the fixed capital method. So under fixed capital method, you need to follow two accounts. One is partner's capital account and the other one is the partner's current account. So under the partner's capital account, since under fixed capital method, we are maintaining a separate account called current account. So in the partner's capital account, you just need to show only the capital details of the partners and nothing else. Show only the capital details of the partners. So this will be, this side we will record the opening capital by balance brought down, opening capital, and this side if any additional capital has been introduced, we will record it here, and then we will close this partner's capital account as a normal ledger closing only. That's all. So this is partner's capital account under fixed capital method. So the fixed capital method separately having partner's current account. So in that current account we will be showing, in that current account we will be showing the other items like current account balances. If they have given, we will be showing that. So interest on capital, partner's salary, partner's commission, P&L appropriation profit or loss, and the debit side of the current account will be shown drawings, interest on drawings, P&L appropriation loss, like that. So if you feel difficult to remember this partner's current account, I can give you a hint that ulta the P&L appropriation account. See, the P&L appropriation account, in the P&L appropriation account we are having debit side interest on capital, partner's salary, commission. In the partner's current account, you will be having credit side interest on capital, salary, commission. So, and vice versa. So, it's very easy to remember this partner's current account. This current account will also show you the closing balance, like normal ledger closing balance only. That's all. It's very, very easy. The next method which I am going to show is the partner's capital account under the fluctuating capital method. Under the fluctuating capital method, we are maintaining only one account called partner's capital account. Under the partner's capital account, under this fluctuating capital method, this two, partner's capital and current account of fixed capital accounts, will be merged in a single account named partner's capital account. Very, very easy. I hope you understand. So under the fluctuating capital method, the partner's capital account will be combining the current account and capital account of the fixed capital method. So if you see, the opening capital will be recorded here, then interest on capital, then salary, then commission, P&L appropriation profit, here drawings, interest on drawings. If the P&L appropriation is having a loss, then we can show it here. Then you close it as a normal ledger closing. Very, very easy. The next topic is the calculation of interest on capital. In the calculation of interest on capital, so if they are asking in the question, calculate interest on capital, and they are telling that this partner has withdrawn and this partner has introduced additional capital, like that, just remember these symbols. If a partner has introduced additional capital, you remember the plus symbol, and if a partner has withdrawn the capital, you remember the minus symbol. So the formula will be like this only. Interest on capital formula is equal to the partner's name, you write it, then opening capital. Opening capital mostly they would have given in the date, April date only. So opening April date. So opening capital, rate of interest by 100 into number of months remaining, mostly it will be 12 if the opening capital date is April. So 12 by 12. If a partner has introduced additional capital, then the symbol will be plus. So then additional capital into how much he has introduced additional capital into rate of interest by 100 into number of months remaining. When he has introduced the additional capital, from that date to the closing of the financial year. Either the closing will be on the March date or on the December date. So we have to calculate from the date of the additional capital introduced to till the date of the closing of the year. Mostly it will be 6, 9, like that. It changes, depends upon the question. So next, if interest on capital has to be calculated when a capital has been withdrawn, same, opening capital, rate of interest by 100 into number of months remaining. So the symbol will be minus, and capital withdrawn into rate of interest by 100 into number of months remaining from the date of capital withdrawn divided by 12. So you will get the interest on capital for the partners. The next concept we are moving to for interest on drawings. So drawings. So if the person is withdrawing at the beginning of each month, the amount, suppose for example say withdraw at the beginning of each month, okay, so 2000. So 2000 into 12, you convert that amount first into per annum. So that's why I have told here amount of drawings per annum. That amount only you have to take it, since it is a month, into 12. Okay, so per annum. into rate of interest by 100 into month calculation will be, if it is beginning of each month, it's 6.5 by 12. Okay. Then if it is the middle of each month, you say 6 by 12. And if it is the end of each month, you say 5.5 by 12. That's all. Very easy. Same formula you apply and you will get the answer. Then the fourth thing in the interest on drawings, withdraw at the beginning of each quarter. So the same amount of drawings per annum. So in a year there is only 4 quarters in a year. So the amount into 4. If he is withdrawing at the beginning of each quarter or middle of each quarter or end of each quarter, you just multiply into 4, because in a year we have only 4 quarters. So amount of drawings per annum into rate of interest by 100 into, if it is beginning of each quarter, you say 7.5 by 12. If it is middle of each quarter, you say 6 by 12. So middle of each quarter and as well as middle of each month. Middle of each month will be 6 by 12. So here also 6 by 12. So same formula. And withdraw at the end of each quarter. End of each quarter will be 4.5 by 12. That's all. And the next concept is, if the partner is withdrawing irregularly, means he withdraws in certain dates without any frequent intervals or without maintaining any uniqueness. He is withdrawing as per his wish. So at that time, first see this date and amount will be given in the question. So you have to, the solution has to be like this: date, amount of drawings, and number of months remaining, and the product. So number of months remaining from this date to the end of the year. What month they have given, December or March, you have to see in the question. So end of the year, when it is ending, so from this date to the end of the year, so some month will be there, and product will be this 2 into 3. So amount into number of months remaining will be the product. Then total the product. Then the formula for calculating interest on drawings under this method will be 4 lakhs into rate of interest. 4 lakhs is this total, product's total, into rate of interest by 100 into 1 by 12. This is very important for this method, 1 by 12. So you will get the answer for this method, interest on drawings. That's it. Next, past adjustments. Many of the students, they feel that this past adjustments table is somewhat difficult and all. So but this is very, very easy. See, first you have to see omitted. Okay, so if the interest on capital is omitted, credit in respective partners column, debit in the firm column. Simple. If you are crediting in the respective partner column, you have to debit in the firms column. Okay. If interest on drawings is omitted, debit in the respective partners column. So if you are debiting in the partner column, then credit in the firm column. Okay. Then if share of profit is omitted, credit in respect to partner column, debit in the firm column. So if debit in partner, credit in firm, vice versa. That's all. Okay. So this way, if you are calculating now, finally you will reach the answer very easily. The journal will also be attained very easily. That's all. Very, very easy. So this past adjustments or incorrect appropriations, I'll be dealing more sums in this, and that time I'll be solving more problems. So that time you'll get a clarity on this. Next will be minimum guarantee of profit. Under this minimum guarantee of profit, the rule is that under minimum guarantee of profit, the rule is that the partner who has been guaranteed the amount of profit has to get a share, guaranteed share. For example, if his share of profit as per the profit sharing ratio is higher than the minimum guarantee of profit also, he will be getting the guaranteed amount of profit only. That's all. Next, loan given by, when a loan has been given by partners to the firm, what should be the journal entry? So in this case, the firm is receiving the money. So bank account debtor to the partner's capital account. That's all. And the loan, when after receiving the loan, the firm has to pay the interest on loan. So when the firm is paying the interest on loan or it becomes payable, it has to be entered as interest on loan account data to interest on loan outstanding account. And next, you have to transfer the interest on loan to the profit and loss account. The entry will be profit and loss account data to interest on loan account. That's all for this chapter. That's all. I will be dealing more sums on it, but in this video I am going to show you only the formats and formulas for the entire class 12 accountancy syllabus from volume 1 to volume 3. So important points to be noted in this chapter. In the first chapter is that when the partnership deed is silent about interest on loan, if the firm has got loan from the partner, then the firm has to pay interest. The party who has got the loan has to pay the interest. We all know that. So in this case, if the partnership deed is silent and the firm has to pay the interest means, then the interest on loan should be paid at 6%, even if the question did not say it is 6% to the partners. The firm has to compulsorily pay 6% interest on loan to the partners, even if the question is silent or partnership deed is also silent, no problem. Then, if the partnership deed is silent, the partners need not pay any interest on loan. If the partnership deed is silent, the partners need not pay any interest on loan to the firm. In this scenario, the partner would have got loan from the firm, but the partnership deed is silent and it is not saying anything about interest on loan means the partner doesn't need to pay any interest on loan. That's all. Next, interest on capital need not be calculated if the rate of interest is not given in the question. And in case of net loss, I have already discussed this, but I am telling you again, while you are preparing the profit and loss appropriation account, in case of net loss is given, you cannot calculate interest on capital, partner's salary and transfer to reserve cannot be shown in the profit and loss appropriation account. Only interest on drawings you can be calculating it. That too, if the period is not mentioned, that too for only 6 months you have to calculate. That's for the first chapter. Formula I will be dealing in chapter 2, nature and valuation of goodwill. So in this chapter we are having only 6 formulas which I will be dealing very shortly. So first is average profit method. The formula is total profit by number of years. The total profit has to be calculated by adding the profit of several years. Suppose if a particular year is showing loss, you minus that loss against with this profits, but you have to calculate that year, that also for the number of years. Okay, that year also for the number of years you have to calculate. Some students, they will be having a doubt, since it is a loss, we have to calculate that year for the number of years or not. So I am telling you, you have to calculate that loss year also for the number of years. Then we have to move on to the normal profit. Normal profit formula is capital employed into normal rate of return. Sometimes in the question they would not have given capital employed directly, so you will have to find that capital employed. So capital employed is equal to assets minus outside liabilities. Okay, so that formula if you are using, you will get the capital employed, then you will multiply with the normal rate of return, you will get the normal profit. Then the super profit formula is minus the answer of the average profit and normal profit. You are getting the super profit. If the question says that find out average profit and find the goodwill, the formula will be average profit into number of years purchased for finding out the goodwill under average profit method. If the question says that super profit has to be found out, then goodwill has to be found out means, so it is under super profit method, goodwill has to be found out. So the formula is super profit into number of years purchase. Then weighted average profit method of goodwill. The formula is weighted average profit divided by total weights. You add all the profits, you get the weighted average profit and the total weights. For example, weighted average profit total weights and product. You can also say WAG, weighted average profit. So multiply this first column with the second column. So you will get a total. So that will be the weighted average profit and total weights 1, 2, 3, 4, 5 added, divided, you will get this. Then you have to find out the goodwill, weighted average profit into number of years purchase. Fifth one will be capitalization method. Capitalization method is otherwise known as capitalization of average profit method. So under this method, for finding out the goodwill, the formula is goodwill is equal to total capitalized value of the firm minus net assets. So in order to find out the total capitalized value of the firm, the formula is average business profit into 100 divided by normal rate of return. So after finding this answer, we have to minus that with the net assets. We will automatically get the goodwill. It's very simple. Then the next formula is capitalization of super profit method. So the goodwill is equal to super profit into 100 divided by normal rate of return. So we know already how to find out super profit and all. So it's very easy to calculate. Then I'll be moving on to the chapter 3, changes in profit sharing ratios. So that sacrificing ratio, new profit sharing ratio, I'll be dealing with the sums. Now I'm not showing that one. In the formats and formulas video, I'm not showing that one. I'm directly moving on to the revaluation account. In the revaluation account, the format is particulars rupees, particulars rupees. The debit side of the revaluation account will be showing increase in the assets. Decrease in the assets, increase in the liabilities, and any unrecorded liability will be shown here in the debit side of the revaluation account. The credit side of the revaluation account will be shown assets increase, liabilities decrease, unrecorded asset. Very simple. And one more thing, I'll give you a hint. This revaluation account shows only the difference value between the old value and the new value. Or if it is an unrecorded liability, then it automatically means that only one value will be there. That value will be directly shown here. That's all. So the result of the revaluation account will be gain or loss. The profit on revaluation account or loss on revaluation account. So this will be shared among the partners in the ratio, in the old ratio. So you have to split this profit on revaluation. You should not show directly the amount of the gain on revaluation here. You have to split the amount in the old ratio of the partners, and then you have to put those amounts in inner column, then total it, then put it in the outer column. Same way for if it is a loss on revaluation also, same method we are going to follow. The next part which I am going to deal with is chapter 4, admission of a partner. In that, the very, very important concept is hidden goodwill. Hidden goodwill is otherwise known as inferred goodwill. So to calculate that hidden goodwill or inferred goodwill, first we have to take the incoming partner's capital and reciprocal it with the share of his incoming partner. So for example, if the incoming partner is bringing in some goodwill, if the incoming partner is bringing in some capital, for example it's 20,000 and his share is 1/4, you have to do it as 20,000 into 4/1. So you will get it 80,000. Okay. So in that 80,000, you have to deduct all the partners' capital, including the incoming or outgoing partners' capital. You will get the total capital of the firm. So the final value will be the goodwill of the firm. So for example, say you have already A, B as a partner and C is the incoming partner. So 3 partner will also having the capital. You add all the 3 capitals even the incoming partner capital also you add it, you will get one amount that is called total capital of the firm. That total capital of the firm should be minused with the total capital of the firm you have already reciprocaled with the incoming partner's capital. So if you do that, you will be getting the goodwill of the firm. That's all. Suppose if you want to find out the goodwill of the particular partner, then from that goodwill of the firm, you have to calculate his share of goodwill using his share. That's all. So this is the hidden goodwill or inferred goodwill calculation. The next important concept will be adjustment of capitals. So majority of the sums, they are saying that the capital has been adjusted by either withdrawing or introducing new capital, that and all. So in case of admission, how they are dealing with the adjustment of capitals means, first they are preparing a revaluation account, then they will be preparing partner's capital account, and after preparing the partner's capital account, they will be arriving at a balance carry down, which means they will be totaling the debit side of the partner and credit side of the partner, finding out the difference between that debit side and credit side for each partner, and that amount, the final amount, the difference amount is called as the adjusted capital of the partner. You total all the adjusted capital of each partner, total it, and split in the new profit sharing ratio for each partner. So you will be having, so now you will be having an adjusted capital and the new capital. So compare the adjusted capital with the new capital. If the new capital is higher than the adjusted capital, that means the partner has introduced additional capital to the firm. If the new capital is lower than the adjusted capital, then it means the partner has withdrawn the capital from the firm. So if it will be debited. So if a partner has withdrawn the capital, it will be debited with the debit side of the partner's capital account. If a partner has introduced the capital, it will be credited in the partner's capital account. That's all regarding the adjustment of capitals account. Then the next topic which I will be covering is the workman compensation reserve. See, if the workman compensation reserve is, the next concept is workman compensation reserve. If the workman compensation reserve, suppose for example, is shown as 90,000 inside the balance sheet. Okay, in that scenario, case 1, when there is no workman compensation claim is given in the adjustments, then you can just share this workman compensation reserve inside the balance sheet in the old profit sharing ratio to the old partners. The journal entry will be for that. So workman compensation reserve account data to old partners capital account in the old profit sharing ratio. The case 2, same way, the workman compensation reserve inside the balance sheet is 90,000 and the workman compensation claim in the adjustments is given as 45,000. So workman compensation claim is rupees 45,000 in the adjustments. In that scenario, we have to pass the journal entry as follows. Workman compensation reserve account data, the reserve is 90,000 inside the balance sheet, and the workman compensation claim, in this reserve claim will be used as 45,000 and the remaining will be shared between the old partners. The purpose of this workman compensation reserve is to support the claim only. So whenever there is a claim on workman compensation reserve, the reserve will be used for paying this claim. So that is the logic here. So next, case 3, if the workman compensation claim is 99,000, which is more than the workman compensation reserve. See, the reserve is 90,000 In the previous case, the claim is only 45,000, which was lower than the workman compensation reserve. Then it is easy to meet it. Suppose you have 100 rupees in your hand and some of your relatives or friends, they are asking 50 rupees. You can give it easily. But when you are having rupees 100 in your hand, how can you give 150? So in that scenario, that is the scenario in case 3. The workman compensation claim is 99,000, but inside the balance sheet they are showing workman compensation reserve is only 90,000. In that case, the claim is more than the reserve, so that extra claim has to be given to the revaluation account. The extra claim is what? 9,000. So the journal entry would be as follows: workman compensation reserve account data, the reserve is 90,000. The difference between the reserve and the claim, the extra claim, has to be given to the revaluation account. So revaluation account data, debit the revaluation account 9,000 to workman compensation claim. They are claiming 99,000. So that's the case 3. So whenever you pass this revaluation account data, the next entry should be automatically old partners capital account data to revaluation account. This 9,000 should be split in the old profit sharing ratio between the old partners. Then case 4, when workman compensation claim is 90,000. So the workman compensation reserve is 90,000. The workman compensation claim is also 90,000. So the journal entry should be workman compensation reserve account data to workman compensation claim account. So the reserve and the claim is same. It's easy that they are entirely spending the reserve for the claim. That's all. The next important concept is investment fluctuation reserve. So the same like the workman compensation reserve, this is also a very important concept. So here I will be explaining. See, in the question they will be showing like this: investment fluctuation reserve and investments. So if you ask what is the purpose of this investment fluctuation reserve, to support the investments when there is a fall in the market value of the investments. So for example, in this scenario, investment fluctuation reserve is 18,000 and the investments inside the balance sheet is 2 lakhs. So case 1, when the market value of the investments is not given. So investments cost price is 2 lakhs inside the balance sheet, but in the case 1, in the adjustments, they have not given the market value of investments. Then in that scenario, just you take this investment fluctuation reserve and share it in the old profit sharing ratio between the old partners. That is case 1. And case 2, when the market value of investments is 2 lakhs, that is given in the adjustments. See, here you have to compare. Case 2, you have to compare investments inside the balance sheet is 2 lakhs and market value of the investments which is given in the adjustment is also 2 lakhs. So 2 lakhs minus 2 lakhs will be 0. So for 0, you don't want to pass any separate journal entry. So the same case 1 journal entry will be followed here also. Okay. So I am repeating the case 2. You just compare the investments inside the balance sheet and compare the investments market value in the adjustments. If you find the difference, you will get 0. So for 0, you don't want to pass any new journal entry. So you just split this investment fluctuation reserve 18,000 in the old partners ratio to the old partners. That's all. So the journal entry would be investment fluctuation reserve account data to old partners capital account. Case 3, when the market value of investments is rupees 1,91,000. The cost price inside the balance sheet is only 2 lakhs and here in the adjustments they have given the market value of investments is rupees 1,91,000. So and that scenario, the journal entry should be like, so here the market value is lesser than this cost price. So it's easy that investment fluctuation reserve account data is 18,000 and two investments, the difference is 9,000. So here there is a fall in the value of investments. See, I have already told you the purpose of creating the investment fluctuation reserve is to support the investments when there is a fall in the market value of the investments. So here in this case 3, there is a fall in the market value of the investments when comparing it to the cost price. So the journal entry should be like investment fluctuation reserve is 18,000. The fall in the market value of the investments 2 lakh minus 1 lakh 91,000 is 9,000. So this investments, two investments account 9,000 and remaining 18,000 minus 9,000, 9,000 remaining should be shared between the old partners in the old profit sharing ratio. That's all. Then case 4. When market value of investments distribute investment fluctuation reserve as in case 1 journal entry. Investments account debtor 18,000 to revaluation account 18,000. Revaluation account debtor to old partners capital account. So in the case 4 scenario, what I am trying to say is that when the market value of investments is more than the cost price of the investments, assume here the rupees is 2,18,000. That's what I am trying to say here. So I have not written here, but you can mention it as when the market value of investments is 2,18,000 and in the balance sheet the cost price of the investments is only 2 lakhs. So in that scenario the journal entry should be like, first you have to distribute the IFR. So investment fluctuation reserve account debtor to the old partners capital account. First that journal entry should be there. Then the next journal entry, the difference is 18,000. So 2 lakh in the balance sheet. And here in the adjustments it is 2,18,000. So 2,18,000 minus 2 lakhs will be 18,000. So investments account debtor 18,000 to revaluation account 18,000. So then as it is revaluation account debtor to old partners capital account, that 18,000 will be split among the old partners in the old profit sharing ratio. So that's all for investment fluctuation reserve. The next very important concept is goodwill concepts. So for admission, retirement, death, and for third chapter also changes in profit sharing ratio also, these goodwill concepts will be helpful for you. So only 6 concepts are there in the goodwill. If you know those 6 concepts, you will never make mistakes in preparing the capital account. So first, if the goodwill already exists in the books, which means the goodwill is already shown in the balance sheet. That's what I'm trying to tell here. So if the goodwill is already existing in the books, the journal entry should be partners capital account debtor to goodwill account in the old profit sharing ratio. This goodwill amount will be shown inside the balance sheet. Okay, that one you can share in the old profit sharing. Case 2 is when a new partner is bringing goodwill to the firm. So the journal entry will be cash account debtor or bank account debtor to premium for goodwill account. So when a new partner is bringing in goodwill to the firm, cash or bank account debtor to premium for goodwill account. So case 3, that premium for goodwill will be distributed to the old partners in the old ratio. So premium for goodwill account debtor to old partners capital account in the old ratio. That's all. In case 4, when the premium for goodwill is withdrawn by the old partners. So old partners capital account debtor to cash or bank account. Since they are withdrawing from the firm, cash is going out. So the journal entry should be like old partners capital account debtor to cash or bank account when the premium for goodwill is withdrawn by the old partners. Then for the case 5, when premium for goodwill is paid privately outside the business. So when it is done privately, which means outside the business, no journal entry has to be passed. Then the final case, when a new partner does not bring goodwill in cash. When the new partner does not bring goodwill in cash, the journal entry should be like new partner's capital account debtor to old partner's capital account. Here the goodwill of the firm will be given. So you have to find out the share of the new partner's goodwill. So new partner's capital account debtor to old partner's capital account in the sacrificing ratio. So this is very important. Only this 6 case are the journal entries for goodwill concepts. I'll be sharing all these notes in the description. I'll be sharing it as a link. You can download it and use it for your study preparations. The next chapter is retirement of a partner. Mostly in chapter 5, retirement of a partner, they are dealing with the adjustment of capitals only, which has been already discussed, and it will be discussed more in detail while doing the problems. So next is death of your partner. So death of a partner, here the format, see in chapter 6, death of a partner, in every question paper if you see, they will be asking deceased partner's capital account, that is to prepare executor's account. Okay, so in executors, how to prepare executor's account means first you have to prepare the deceased partner's capital account, then only you will be able to prepare the executor's account. So deceased partner's capital account, how to prepare? First, deceased partner's capital, which will be given inside the balance sheet. Then interest on capital, month calculation will be shown. Salary, month calculation will be shown. Then revaluation profit for this partner. And this deceased partner's capital account will show only the details of the deceased partner only. So that's why, for example, the deceased partner name is A, means you say A partner, A's capital account. Particulars rupees, particulars rupees. That's fine for this format. Then revaluation profit for the deceased partner, and goodwill, and profit and loss account, profit and loss suspense account. You have to say profit and loss suspense account. This goodwill and profit and loss suspense account details will be given in the question. In the adjustment section, you have to find the gaining and sacrificing ratio and split the goodwill in that ratio only. So this, if you don't understand now, just see the format for now, and while doing the problems it will be discussed more in detail. So it will be very easy for you. Just now in this stage you just need to know the formats. How? See, if you know the formats, you can just fill the format and put the amount, automatically everything will be correct. So this format will help you 100% to give your best while preparing the deceased partner's capital account. It's very easy. Okay. Next, chapter 7, dissolution of a partnership firm. In this chapter, the very important concept is realization account. Before diving into this realization account, there are some important guidelines to be followed to prepare a realization account. So the guidelines to prepare a realization account is, in the debit side you will be transferring all the assets except fictitious assets, loan to partners, and cash or bank accounts. So I repeat, the first thing, see, in the case of realization account, only 7 to 8 mandatory things are there. If you follow that 7 to 8 mandatory things, you will never be making mistakes in preparing this realization account, and this realization account is very easy and also very important. So I just want to make very clear how to prepare the realization account. So in the debit side of the realization account, first you have to put the old assets. Okay, so to sundry assets, you should not record the fictitious assets, and you should not record the loans given to the partners inside this realization account, and you should not show the cash or bank account inside this realization account. I am talking about the old assets. Okay, then in the credit side, you will have to transfer all the liabilities except loans given by partners to the firm. Loans taken by partners and loans given by partners should not be recorded inside this realization account. Okay, the next concept is to show the assets taken over or liabilities paid off. Okay, inside this realization account, the very important concept is that if a loan has been given to the partner, it will not be recorded. But if, for example, A is a partner and A's wife has got a loan from this firm, and A as a partner, he has paid off his wife's loan. In that scenario, that will be shown in the debit side of the realization account. So a liability has been paid off. So instead of bank or cash, you put the A's capital account like that, because A has paid off his wife's loan. So A's capital account like that you have to put, and you can close it off. That's all. Then assets taken over by any partner. If the assets, for example, furniture took over by A, like that, so by partner's capital account, that asset name. That's all. Very easy. Then assets realized, you say by bank, and what are all the assets realized. Here the very important concept is, in case of assets, if the asset is a tangible asset and if the realized value is not given in the adjustment. For example, inside the balance sheet, the furniture value is showing 2 lakhs, but in the realized value, in the adjustments, the furniture value, they have not mentioned anything. It means the furniture has been realized for this 2 lakh rupees only. So since it is a tangible asset, I am repeating, since it is a tangible asset, the furniture value of 2 lakhs which is shown inside the balance sheet will be taken and recorded here under the head assets realized, under this bank. By bank you put and record furniture like that. Same scenario you take it for intangible asset. For example, there is some intangible asset inside the balance sheet like goodwill. For goodwill they are saying 50,000 inside the balance sheet, and in the adjustment they have not given anything about the new value or realized value of the goodwill. Then it means you should not record the intangible asset realized. You should not record the value of the intangible asset under this bank head. Okay, so it's very important. Tangible asset means you have to take the old value for the realized value. Simple. And intangible asset means if the realized value is not given, you should not record the asset, intangible asset, in the realized part. Okay, then liabilities paid off. Then the next concept will be realization expenses paid. So it will be like realization expenses account data to bank account. You can say to bank account bracket realization expenses also. The result of this realization account shows either gain on realization or loss on realization. That will be split among the partners in the ratio. Okay, the old ratio. While preparing a realization account, some important points that ought to be noted here is when a liability is paid off using an asset, it will not be shown in the realization account and no journal entry will be passed for this. I am repeating, very important. When a liability is paid off using an asset, for example, creditors took over investments for settling their debts, like that, if the question is there, then you should not pass any journal entry. As a result, that will not be reflected in the realization account also. Okay. Then next, when realized value of tangible asset is not given, I have already told that and I am repeating here. When realized value of tangible asset is not given, the realized value shown as old value of the asset. The realized old value will also be same, realized value is also same. Okay. When the realized value of intangible asset is not given, the realized value of intangible asset should not be shown. Okay. Then when realized value of prepaid expenses and accrued income is not given, the realized value of prepaid expenses and accrued income should not be shown. When the realization expenses are borne and paid by a partner, then it should not be shown inside the realization account and no journal entry has to be passed. So very important concepts, and that's all for the realization account, and that's all for volume 1. So I think I have covered 95% of volume 1 in this, except some few for that changes in profit sharing ratios and all I have not covered, but in the upcoming videos I'll be covering with the practical problems, everything what I have all missed. Only 5% of the things I would have been missed in volume 1, but I'll be covering those topics very shortly during the problem sections. Okay, and please, I'll be sharing, if you feel this video is very useful, I'll be sharing my notes in the description section as a link. You can just download it and use it for your study purpose.